right, good morning, everybody. It's Tuesday, Jan 31st. This is Dan Sheridan, and tomorrow is the big kahuna. The Fed is going to come out tomorrow at 1 Central, and they're going to say, well, we're going to raise the rate quarter point, or that's the expectation. And then a half hour later at 1:30, there'll be a press conference. And I think that's going to be maybe quite a bit more important, because then they'll say, you know, we raised it a quarter and we're thinking this is about it, which could rally the market. Or they could say, we raised it a quarter, but we're still nervous about this thing. So it's might be more what they say at the press conference. And then I think the festivities will continue into Friday, in that all the Wall Street gurus will decide Thursday night, Friday morning, okay, all right, is this good? Is it bad? Is it good? And so, you know, a lot of times Friday could be the kind of frosting on the cake. So a little more volatile potential Thursday and Friday. As I said, it's potential. Could do nothing, right? They could do a quarter point and nothing. But for range-bound traders, which we are, positive theta traders here at Sheridan Mentoring, it's not worth jumping in the ocean, which seems calm now, when tomorrow they could be having a shark birthday party is scheduled near the shore tomorrow. Well, the sharks may come, they may not, but do I want to take that risk for range-bound type trades? Also tomorrow, you have some more catalysts coming. Apple, Amazon, Google have earnings after the close tomorrow. You have Friday non-farm payroll. So you have quite a bit of things here, right? Quite a bit of things. And the other thing is, so anyways, that's where we're at, right? So, but I want to, with all that being said, one trade I was looking at, and interesting, that I might put on for, well, I have something like this on, well, I have this on, but for a range-bound trade, not a lot of risk. But again, if I'm going to do a range-bound trade, that I'm going to go overnight, or that I'm going to have on tomorrow with the Fed announcement, which it doesn't make a lot of sense, but it would be smaller size. But here's something I've been looking at, which is I like. I'll just introduce it to you. I'm going to call this a double long diagonal. It's different. And so if you look at the foundation, so here I'm looking at Feb 10, I'm selling the 40-90 calls. The blue is the expiration graph. That's going to be in about 11, 12 days. And the long options are 3 days further out than the ones I'm buying. So I'm selling Feb 10, buying Feb 13. So I'm selling the 40-90 calls in Feb 10. And today is Jan 31, so it's about 11 days out. And I'm selling the 39.80 puts. And this is all with SPX at 40.42. All right, so let's start there. What is that? Well, Dan, you're selling an out-of-the-money call and an out-of-the-money put. If SPX is 40.42, so you're selling this out-of-the-money call about 50 points higher than where we're trading, and you're selling an out-of-the-money put about 60 points lower. Okay. All right. What's that called? It's called a short strangle. What's a short strangle? I sell an out of the money call and put. Well, why would you do it? Well, you're bringing in, you're selling an out of the money option. So you're getting some probability in your favor because you're selling things away from the current price. You're getting some time decay because as you sell anything, it's all extrinsic value when you sell out of the money calls and puts. So you can see here in the Greeks, one of the Greeks is time decay. So this is saying on this trade, you're bringing in about $93 a day on theta. Now, so this is the foundation of this double long diagonal. I teach a double diagonal. The double diagonal would be, I'm going to buy my hedges a little bit further out. So these are Feb 10. A double diagonal, I'm saying, hey, I would buy my hedges against these because I don't want to do naked options. I'd go to Feb 13 and I'd buy an out of the money call, right? Like Feb 13, 4100 call. Or I'd buy an out of the money put in Feb 13, like a 3970 put. That's a double diagonal. This is a double long diagonal. And all it means is your longs, instead of being out of the money with a double diagonal, are going to be in the money. So you can see here, I'm buying against this. I'm buying the Feb 13 4080 calls. So in Feb 13, I'm buying the 4080 calls a little more in the money than my shorts. And then the puts, I'm buying the Feb 13 3990 puts, 10 points more in the money. And the biggest difference between this and a double diagonal, the double long diagonal, because your longs are more in the money versus a little more in the money versus your shorts, the capital requirements for this trade are less. You don't have to put as much capital, there's not as much risk. And generally, from a risk management, as long as you're between the short options, which are the two peaks here of the mountaintop, you're fine. But you have these things, expiration break evens, roughly somewhere around here. But for visual learners, all of this area is where you do pretty good. As it goes beyond this, you'd have to adjust or take it off, or that's where risk management would come in. This graph, and I'm using TD Ameritrade Thinkorswim, this graph is your expiration graph in 12 days. This is your graph today. We call it T+0. But anyways, let me talk more about this in a future YouTuber, but that's a kind of range-bound trade that we use that's pretty good. And when you talk about range-bound, you're talking about positive theta trade. The options you're selling, in this case, the Feb 10, 3980 put and 4090 call, are going to decay quicker than your long hedges, Feb 13, 4080 call and 3990. Why are they going to decay quicker? Well, because they're Feb 10. They're going to expire quicker. So you're going to have more decada. You're going to have more theta decay on your shorts than your longs. Why? Because they're closer in expiration. So this is a decent a range-bound trade that we use when VIX is in the lower end of the range volatility. which it is over the last 6 weeks. You might be like 18 to 25. So anyways, something to put in your pipe and think about or smoke about. And that's what I got today. So I'm Dan Sheridan, Sheridan Mentoring. Have a nice day, everybody, and we'll talk to you later. Thanks.